If I had to start putting money to work today from scratch, knowing what I know about the failed talks, the fragile ceasefire, the naval squeeze now forming around Iran, and the way this market has been reacting to every whisper of peace and every hint of escalation, I would not be thinking about the next headline the way most people are thinking about it right now. Most people are asking whether this is bullish for tomorrow, bearish for tomorrow, or something in between. But that's not really what this is about anymore. We are staring at a market that just got reminded again that geopolitics can reprice risk in a hurry, and when that happens, the biggest opportunities usually do not show up in the calm. They show up in the confusion. Today in New York, it is Monday, April 13th. Comment the day and date you're watching from. And real quick, if you appreciate the work that goes into these breakdowns, subscribe and comment John A.G. Best so I know you want more of this. Now, the simple version of this story is easy. Talks in Islamabad failed. The ceasefire still appears to hold for the moment. The United States moved toward a blockade of Iranian ports. Oil jumped back above $100 a barrel. Stock futures turned shaky. End of story. But that's not actually the story. That's just the headline stack. The real story is what happens when a market that had started to believe in relief suddenly has to price in pressure all over again. That relief trade was real. Stocks had bounced hard when the ceasefire headlines hit. The broad market climbed back above major technical levels, and the optimism came fast because people wanted a reason to believe the danger had passed. From recent market updates, the move back above the long-term average on the main index was one of the clearest signs that traders had started leaning toward a calmer path. Then the talks broke down, and the biggest sticking point looked a lot like the one everybody feared it would be: uranium enrichment and the wider nuclear question. That matters because it tells you the disagreement was not some side issue. It was the core issue. At the same time, this thing is still not fully blown open. The ceasefire window runs into late April. So we're in that awkward zone where a lot of people will talk as if they know exactly what comes next, but they don't. Maybe the ceasefire holds. Maybe back-channel diplomacy picks up again. Maybe Iran waits and watches. Maybe it retaliates indirectly. Maybe the blockade becomes leverage. Maybe it becomes gasoline on the fire. Anybody speaking with total certainty right now is selling you confidence, not clarity. And that uncertainty is exactly why this market can create opportunities for both investors and traders at the same time. Let's start with the geopolitical piece, because this is where the raw material for the opportunity is coming from. The new American move is not just another speech, not just another warning, not just another dramatic phrase tossed into the air. It is a shipping and pressure story now. The United States said it would block vessels going to and from Iranian ports, while still allowing ships moving between non-Iranian ports to pass through the strait. That changes the frame. It means the market now has to think less about symbolism and more about barrels, routes, insurance, delays, retaliation risk, and how long the energy market can stay tight if this drags on. Based on freshly reported coverage today, the blockade starts immediately, and the message from Washington is that Iranian exports are the target, not general commercial passage. That is a very different setup from a total shutdown, but it is still a major escalation. Oil understood that instantly. Crude surged back into triple digits, and it did not take much for inflation fears to come right back with it. March consumer inflation in the United States just jumped to the low threes year over year, with the monthly rise the hottest in years, and energy was the loud part of the print. At nearly the same time, the government revised fourth quarter growth down to roughly 0.5% annualized. So you've got softer growth, hotter inflation, and now another oil shock layered on top. That is not the sort of backdrop where investors should be sleepwalking through their decisions. That is the kind of backdrop where the market can still rally, but only if people believe the bad macro can be postponed for long enough. That is why I want to challenge one popular idea floating around this story. I'm not fully convinced this naval move is automatically some brilliant masterstroke that resolves the strategic balance. It may be smarter than simply bombing more targets, yes. It may be more economically painful for Iran, yes. But strategy only deserves praise if it creates leverage without causing a much bigger mess 2 steps later. And right now, we still have a giant wildcard hanging over the whole thing. Iran can respond directly, indirectly, regionally, economically, or not right away at all. Israel is another wild card because it is not bound by some neat bilateral script, so I would be careful with anyone making this sound clean. It is not clean, it is unstable. And unstable markets are where selection matters. If you're an investor, the biggest mistake you can make right now is to treat this like a shopping spree where anything that fell is suddenly a bargain. That is not how real wealth gets built. You don't buy a stock because it used to be higher. You buy a business because the next few years still belong to it. Those are different things. Some companies are down because sentiment got ugly. Others are down because their future is actually less secure than it used to be. If you can't tell the difference, this kind of volatility will punish you. That is why my focus keeps coming back to selected large technology names. Not all technology, not every software chart that got smashed, but the businesses tied to real spending, real infrastructure, real enterprise dependence, and real platform power. The broad idea is simple. When uncertainty hits, I want the names that still have cash, still have demand, still have pricing power, and still sit in the center of where the next wave of spending is actually going. Right now, that still points me toward the biggest platforms, the biggest cloud ecosystems, the biggest chip leverage stories, and a few cybersecurity names that may have been punished too hard. According to the latest publicly available filings and company statements, the spending race in artificial intelligence is still enormous. One giant e-commerce and cloud company now expects capital spending this year of roughly $200 billion, mostly tied to infrastructure. One major social platform just expanded an AI cloud deal by around $20 billion on top of an earlier huge agreement. One major search and cloud company has signaled that spending on technical infrastructure could rise sharply again after already investing heavily last year. And the broader estimate for what the biggest technology firms may pour into data centers and AI hardware this year runs into the several hundred billion range. That does not guarantee easy returns. In fact, one risk here is that the spending wave outruns the near-term payoff, but it absolutely tells you where conviction still lives. That matters because leadership in the market is usually not random. When money gets nervous and then starts to creep back in, it often goes first to the names with the clearest revenue engines and the widest moats. We already saw that on the Ceasefire bounce. The big platforms with advertising strength, cloud exposure, semiconductor leverage, or giant distribution networks responded first. That is information. Not a promise, but information. When the next pullback comes, I would rather study the names that proved they can attract money quickly than the names people only defend with nostalgia. And yes, I know the pushback. What about software names that look so much cheaper now? What about former favorites trading way below old highs? Fine. Some may work. But stock picking is not archaeology. You are not digging through ruins looking for whatever used to matter. You are trying to identify who can still command attention, spending, and market share in the environment ahead. Artificial intelligence is going to make some businesses stronger, some weaker, and some less necessary than people realize. That means price alone is not your edge. Judgment is. This is also where cybersecurity gets interesting to me. There is a decent case that some security names sold off too hard because the market started worrying that AI changes the stack. Maybe it does, but it can also make the need for protection, identity control, response systems, and network defense bigger, not smaller. So while I would be careful chasing anything blindly, I do think there is room to be selective there if the volatility hands you prices you like. If you're investing, my base approach stays simple. Ignore the daily noise. Build a deliberate list. Decide what you would truly regret not owning if this market shakes out, resets, and then eventually runs. Scale in on weakness. Consider cash-secured puts if you understand them and actually want to own the underlying names. Keep some dry powder for fear spikes. And above all, do not confuse a scary week with a broken multi-year thesis, because the market can absolutely do something that feels unfair from here. It can wobble on failed talks, pull back on oil, shake everybody loose, and then rip again if diplomacy comes back into the picture before the ceasefire deadline. We have seen this kind of sequence before. Markets can rally first and let the macro pain arrive later. That doesn't mean the macro risks are fake. It means markets discount the next story before they fully price the final damage. So I am not in the doom camp here. I am in the turbulence with opportunity camp. If you're successful, share your success story in the comments so others can stay motivated. Now, if you're a trader, your job is different. You do have to care about the noise. You do have to care about overnight futures, energy gaps, shipping headlines, and whether volatility products are getting aggressively bid again. For traders, I still think the cleaner setups come from pullbacks in the names that already showed leadership during the rebound, not random hero trades in laggards. Strong names tend to stay strong longer than people expect, and weak names can stay weak even when the index bounces. That's why relative strength matters so much in a tape like this. Volatility matters too. In high volatility markets, buying options without a plan can torch you because rich premium cuts both ways. If you're wrong on timing, the market doesn't just move against you. Decay and implied volatility can pile on. That's why defined risk premium selling often has an edge here. Credit spreads, thoughtful structures, positions placed outside the expected range rather than desperate guesses at the exact next move. It is not glamorous, but it can be incredibly effective when fear makes options expensive. I also think traders have to stay humble about direction right now. This market could retrace the optimism rally, yes. Oil could stay elevated, yes. But if the ceasefire survives a bit longer or negotiations quietly resume, the broad index could still lurch back toward prior highs before the bigger macro strain really bites. We have historical examples of years where the market put in one more strong leg, even while the economy was already getting tired under the surface. That is why stubbornness is so dangerous. The tape can stay weirder than your conviction can stay solvent. And one more thing, because this matters more than people think. Big firms on Wall Street have not suddenly turned uniformly bearish just because the Middle East got hotter again. One large global wealth manager cut its target for the main American index last week because of energy risks, but it still kept a positive view on profits and still expects a recovery path later this year. That tells you something important. Even the cautious people are not necessarily saying the entire equity story is broken. They are saying the path got rougher. That is a very different message from sell everything and hide. The same goes for the central bank angle. A lot of traders keep acting like any growth wobble automatically means easier policy is coming. Maybe eventually. But with oil back above 100 and inflation already reaccelerating, rate cuts are not some easy gift the market can just count on. The central bank may stay pinned between weak growth and sticky prices longer than people want. That means stock selection matters even more, because you cannot simply assume looser money will bail out every weak balance sheet and every overpromised growth story. This is one of those periods where quality, cash generation, and leadership can matter a lot more than hope. So when you see volatility pop, do not just think danger. Think information. Ask yourself which names are holding up best, which names recover first, and which names the market keeps returning to whenever fear cools off for even a day. Those are clues. The tape is talking. You just have to listen without getting hypnotized by every dramatic headline. That habit alone can save you from chasing weak stories while the real leaders set up the next move. So here's the big picture as I see it. Short term, I expect shakiness, fast reversals, and a lot of people getting trapped by overconfidence. Medium term, I still think the best opportunities come from selective ownership and selective trading in the strongest businesses, not blind buying across the board. Long term, I think the next 5 years can still offer a huge wealth opportunity, but only for people who stop chasing noise and start building a framework. Use the volatility. Do not worship it. Use the fear. Do not marry it. Use the pullbacks to study leadership. Use the headlines to understand where pressure is building. Use the confusion to decide what you would actually want to own if the world stays messy longer than everybody hopes. Because 5 years from now, most people will not remember every rumor, every press conference, every tanker map, or every panic candle. They will remember whether they froze, chased, or positioned themselves when the opportunity was hiding inside the disorder. And that, to me, is the whole point of this moment. This is for education, not personal financial advice. I'm showing you how I think through a messy tape so you can sharpen your own process, not telling you what to buy, sell, or risk with your own money.